take it from there. So on the off chance that anyone has downloaded the review session, welcome. We are going to be reviewing some material from the course before wrapping up this evening. I am Brian Clark, and this is the British Columbia section of the course, Fundamentals of Income Tax Level 1. All right, so as always, questions are key to making this course come alive and be interactive. So if you have any questions about anything we're talking about, now is the time. Now is your last chance. In terms of class times, we are not going to be needing the full 3 hours tonight. I will be here for the full 3 hours because I'm going to be doing things like entering people's marks and making sure that all is well behind the scenes, things like that. But you, my students, do not have to hang around for the full 3 hours. So do not worry, we will have you on your way well before that, depending, of course, on how many questions we get. Right, so we're going to be reviewing the material from the course tonight. Now, although this is in the schedule as an exam review and in the course outline as an exam review, that is something of a holdover from the days that we had a computer software exam to end the course with, which we no longer do. Compared to some courses that you might take in some places, we do like to keep firm control over the specific questions of the exam, and also bear in mind that not everyone wrote exactly the same exam. So think of this more as a review of major course topics that were covered in the exam, and I think that should cover it. We're also going to talk briefly about the certificates for course completion that you guys are going to get, and what's going to be happening next generally. So certificates of course completion, the tuition tax receipts, which we'll be sending out to you, and then we're going to talk about course evaluations, and then downloading course materials from Inkling and things like that. And then if we have time, we'll just relax and have a little fun Christmas thing at the end. Of course, traditionally we would finish with hot chocolate and cookies and cake. So I hope you've all brought some hot chocolate and cookies and cake. And if you happen to be listening to a recording of this, please do get some holiday snacks. And we will continue. All right. So to be clear, it is not possible for us to ask exam questions which cover every single bit of material covered in the course. As I've been saying all fall, there's simply more material in the textbook than can be covered in 3 hours in class, and then can be covered in a 2-hour exam. The exam is intended to give us a sense of your command of the material rather than being exhaustive. This is not a civil service exam or something like that. As I said when we moved from the 3-hour to the 2-hour exam format, as one of my old professors said in university, I have read nothing written in the 3rd hour of an exam which changed my opinion about the grade based on the first 2. So we felt we would move to a shorter exam, and so the questions are meant to be representative. If you wrote the exam a second time, your second attempt will have repeated some questions from the first attempt, but would also have new questions. None of you wrote exactly the same exam, although there are some questions which all of you had. So because of that, therefore, and because we like to keep a lid on questions, this review is going to cover more of the topics that were examined in your attempts of writing the exam. And we're not reviewing the answers themselves, but the topics that we examined. So we're just going to be going through topic by topic, and this is your chance to ask any questions which remain outstanding. If there's anything you're still unclear on, now's the time for us to get into it. So kind of one of the most basic topics, one of the most fundamental topics in doing Canadian taxes is the concept of residence, and specifically the province of residence, right? It's important when we do someone's taxes to determine the correct province of residence for this person. This is important when we determine the provincial tax rate that someone qualifies for. And as I think you have seen from the tax software that we use, the province of residence selected for someone will dictate what specific tax forms are available in some cases, what provincial non-refundable credits and refundable credits they can claim, and so on. It also has a lot of effect on certain federal credits, such as tuition, where the federal credit might be claimable, but there may or may not be a provincial credit that corresponds to it, depending on your province of residence. Also, the provincial side of things, but it's also important to remember that no matter which province you're in, the pattern of the provincial tax calculation follows the federal pattern. The provincial 428 form follows step 5 of the federal form, and this means that the provinces will vary by tax rates, tax brackets, non-refundable tax credits, and refundable tax credits. But for example, there's no such thing as a provincial deduction. All deductions are federal, and the federal income amount, taxable income amount, is what's used for the provincial tax calculations. All right. For all of those, though, it's necessary to make sure that we have the correct province of residence, and this, for this, we sometimes have to pay very close attention to where a taxpayer is actually living, what their living situation is. Residence, again, it's not, despite it using some of the language of immigration status, it is not based on immigration status, but simply the regular sense of the meaning of where is someone living. Simply staying in temporary housing or an Airbnb situation does not change your province of residence. It is the place where you regularly live changing. All right. Now, for the T1135, so we talked a lot about this and the importance of being aware of this form and the need to file it. So this is when someone has specified property, specified foreign property outside of Canada. So this can either be one asset or a combination of assets whose total value is more than $100,000 Canadian. And for this purpose, the property, again, has to be non-personal use property and not property that's being actively used in a business. So, for example, I think if that seems unclear, so for example, if you had a Canadian business which had, say, valuable ships which were actively moving around the globe, that would not be considered foreign property or things like that. The key thing with the T1135 is that it has to be filed every year. And if it is not filed, there are significant financial penalties for doing so. And it has to be filed even if there is no income from a property or there has been no disposition of the property. Speaking of property and personal use properties, since 2019, it is necessary to report the disposition of your principal residence on the tax return. And like the T1135, there can be steep penalties for not reporting this at the time the return is filed. And the cost of doing so in some cases could be greater than the cost of reporting the disposition of your principal residence. Again, the purpose of making this declaration is so that the sale of your principal residence is not treated as a capital gain. It is important to mention that you are not obligated to report the sale of your principal residence if you are not claiming this exemption, which, for example, if you sold a principal residence at a loss, as unlikely as that might be, then you would not want to claim the principal residence exemption because then you would simply want to claim it as a capital loss. That might be something you did in the case where a principal residence was destroyed or damaged by fire or something like that. So, but when a principal residence is sold and you want to be exempt from capital gains, then you have to make this declaration on the tax return. We also talked about refundable credits in many cases which are independent of the tax return that are instead paid throughout the tax year. So there are several of these. The most commonly known are the Canada Child Benefit and the GST, HST credit, but there's also a few others such as the Canada Workers Benefit. These are all based on the net income from the tax return, and they are paid out throughout the year. Other factors which can influence these include marital status and the number of dependents. The forthcoming Canada Disability Benefit, I think, is going to be a new entry in this category. For adjustment requests, we've talked about these, and we've talked about filing deadlines. So for filing deadlines, all tax returns have to be filed by April 30th of the following year, or the first Monday after April 30th, if April 30th falls on a weekend. If someone is self-employed, then their tax return needs to be filed by June 15th or on the Monday following June 15th, if that is on a weekend. These deadlines are not normally extended, except in the case of some sort of disruption at the CRA. The most recent time this happened was during COVID, when the filing deadlines were extended by a full month due to the havoc that caused on all segments of society, but particularly on the Canada Revenue Agency, which suddenly found itself having to completely reorient and having all of its workers suddenly needing to work from home. Now, bearing in mind that things need to be filed by April 30th of the year following, adjustment requests and late tax returns can be filed for up to 10 full years after the end of the calendar year. So, for example, a late filing for tax year 2015 or an adjustment request for tax year 2015 can be filed up to December 31st of this month. Although I must stress, we do not advise leaving it that late. And all precautions should be taken if you're doing that. But so long as it is submitted by that date, the CRA will process it, or at least attempt to, bearing in mind that there is no incentive for the CRA to try to run out the clock on something. The key point there is that 10-year limit is the limit on when things can be filed or adjusted to receive a refund. It is technically possible to file things that are older than 10 years, but because no refund is possible, typically this is only done in rare cases. I've only done it 3 times in 15 years. Bear in mind that some things, because they are not tax fundamentally, do not receive the full 10-year window. So the BC sales tax credit, for example, the CPP overpayments and EI overpayments have a shorter window of 3 years for EI. 3 years for 3 years for EI, 3 years for BC sales tax, and 4 years for CPP. So, and certain changes cannot be made for the full 10 years. So pension income splitting you can only make changes to that for a 3-year window. And in general, discretionary things such as depreciation claimed in a business cannot be changed once submitted. So there are some exceptions to the 10-year policy. But in general, if you've never sent in a tax return or never made an adjustment, then you've got that 10-year window in play. Tips. So tips are other employment income. That's the main thing to stress, and they need to be reported. The key concept we want to get across at this level is that it is the responsibility of the taxpayer to keep a logbook of the tips, to keep track of the tips. The CRA's position is that it is not sufficient to simply estimate the tips as a percentage of your income. So when someone comes in to get their taxes done, it's important for us to ask them about it and say, are you keeping a logbook? Are your tips recorded as part of your T4? Are you working in a position where you get tips? Obviously, someone who is working in the kitchen or as a janitor or something might not be getting tips in the same way that a front of house person would be. Obviously, some restaurants, the tips will be included on the T4 and so on. All right. Refundable credits. How many refundable credits? So the big ones, again, the Advanced Canada Workers Benefit, the GST credit, the Canada Child Benefit, and the New Canada Disability Benefit. Those are the big ones. There might be one or two other ones I'm aware of, but most of those are going to be provincial credits of one type or another that are normally attached to either the federal child benefit credits, so there are, say, corresponding provincial child benefits which are attached to that, or corresponding provincial HST credits which are included to the federal one. A big one would be the Ontario Trillium benefit. So for we didn't talk about Ontario's Trillium benefit at all, of course, because we're not an Ontario-based section. But for taxpayers in Ontario, Ontario Trillium benefits are a fairly major topic for their returns. All right, so moving on a bit, a lot of topics that we covered have to do with students. In particular, scholarships and awards that are sent to students are often not considered income. I don't like referring to them as tax exempt because that can be a bit misleading. The fact is, if a student qualifies, then only some, and in some cases none, of the scholarship appears on the tax return at all. So elementary school students and secondary school students, those scholarships do not appear on the tax return at all. They are not included income, considered income. For full-time students, that is at least 1 month as a full-time student during a year, full-time students, those scholarship and bursary type payments are also not considered income. For part-time students, they will be partially excluded from the tax return. So the first $500 of the income, plus the amount of any tuition, plus the amount of any fees related to the program, that amount is excluded from income. A similar concept exists for things like research grants, study grants, artist grants, and so on, where the first 500 plus any materials or expenses related to the income are excluded from it. For someone who is not a student at all, who just receives some kind of scholastic prize, but for some reason is not currently any sort of student in the year when they receive it, the first 500 is exempt and doesn't appear on the tax return, and the remainder does. Tuition kind of spins out from scholarships because, of course, a student's full-time or part-time status is recorded on the tuition form. Again, as of around 2019, these tuition forms are filed with the CRA and are on file with the CRA. Prior to that date, they cannot be found on the CRA website and must be obtained directly from the institution. Tuition is claimed as a tax credit. There are two types of credits, the old-style tuition tax credit and the newer Canada Training Credit. If you are claiming the Canada Training Credit, it is restricted to taxpayers 25 to 65 because it is intended as a retraining credit, and under this credit, up to 50% of the current year's tuition or their training credit limit, whichever is lower, is claimed as a refundable tax credit. So what that means, for example, if someone has sufficient room, if someone pays $1,000 in tuition, they will receive $500 back. So dollar for dollar. The first up to 50% of their tuition is paid back as a refundable credit, and then the remainder is treated as a traditional tuition credit. Traditional tuition credits give credit at the normal federal and provincial rate. The main consideration with tuition credits is that they never expire. The flip side of that is that they must be used if they can be used to reduce a student's tax to zero. They must, for example, be used ahead of discretionary credits such as medical expenses or charitable donations. It is not possible to preserve your tuition by donating things to charity. They do, however, happen after deductions. So technically speaking, you could use deductions such as RSP deductions to preserve your tuition, although that might not make the most tactical sense. Other things with tuition, the main thing to keep in mind with the carry forwards is that amounts which are not carried for, which do not need to be used in the current year to reduce tax to zero, those amounts can either be carried forward or transferred, but only in the current year. When they are transferred in the current year, they can be transferred to the spouse or the parents or grandparents. The spouse will have priority, so they can only be transferred to the parent or grandparent if the spouse is not claiming them. And furthermore, there is a limit of $5,000. So any amount which needs to be used to reduce the student's tax to zero is deducted from the $5,000 limit rather than the total of the tuition. All right, so on what specific situation can the cost of textbooks be allowed as tuition? In general, they cannot be claimed. They cannot be added to the tuition. The only thing we can add to tuition is, well, let me pull up the textbook because I think that might be helpful here. So in general, it's important to remember that, I want this. So it's important to remember that the only things we can claim for tuition as a general rule are the things which are the amounts which are listed on the T2202. We cannot, it is up to the institution to determine what can be included as tuition on the T2202. The only times where textbooks might come into it, bear in mind that historically there was for a brief period a tuition amount, which was a flat amount, which was claimed as a credit. That's the only thing traditionally where it comes in. The one thing I want to check, though, is so in general, tuition credits are only claimed for fees. The one exception where you might be claiming textbooks is if you are writing an exam, an occupational exam or a trade exam, and in those cases, those fees may include things like prerequisite study materials, right, which could include textbooks in those cases. So in cases where the tuition is for an exam and is not on a T2202, in those cases, textbooks might be included. But there again, you would have a letter from the institution involved or the body such as the Justice Society involved, and they would provide you with a letter saying what the fees were. In general, we would not be adding in the cost of textbooks. for tuition. All right. The cost of textbooks do, however, factor in when you're figuring out the exemption for scholarship income. So that's why they do come. They can come up sometimes and can be relevant sometimes, but in general, they're not claimed as a credit. And yes, I have had to explain that to several students over the years. There are, it's not really a level 1 topic, but there are some situations in which a textbook might be claimable under some other provision. So, for example, if you were going to school for business purposes, then you might claim the textbooks as a business expense, but you still wouldn't be claiming them as a tuition expense. All right, there we go. Okay, so we've covered all of those guys. Now, Canada Workers Benefit at the bottom of the page here. Again, that's one of the refundable tax credits we mentioned previously. What we wanted to stress is that receiving it is based on your eligibility, which is based on your working income and your family net income. The key thing for the Canada Workers Benefit is that you need to have a certain minimum amount of earned income. It is aimed at people who are working, and your family net income needs to be below a certain threshold. The thresholds can vary by province, although currently most of the provinces match the federal thresholds. It used to be that British Columbia had higher and lower thresholds, but that has been changed recently. I believe currently there's only a few provinces, I think maybe Alberta, a couple of the territories, and Quebec have different thresholds. But by and large, all the provinces and the federal government have the same thresholds for the Canada Workers Benefit, and thus they use the same Schedule 6 for it. The key concepts there are you need to have earned income over a certain threshold. The family net income needs to be under a certain threshold. If you receive the Canada Workers Benefit in 1 year, you will then receive an advanced Canada Workers Benefit in the following year, and it only will, which is in effect an advance payment of part of your next year's tax return refund. And in the event that you don't qualify for it in the next year, it is not required to be repaid. The government's assumption is you needed the money, so they are not, in order to save themselves the administrative trouble, they will not try to collect it in that case. For OAS and EI repayment, they are two different calculations, but they interact. For this one, I will show you the federal worksheet, which should be just down here. So many things I download for this course. I keep them all in one place. That's the idea. Whoop, wait. Not that one. This one. There we go. Well, fillable forms. So in the federal worksheet is where we can calculate OAS repayment. Now, this is referred to as social benefits repayment. And again, the federal worksheet itself, remember the federal worksheet is what we use for any calculation which does not have to be included with the return. Unlike a schedule, the federal worksheet is not attached to the return. It even says there, do not attach it to your return. It's just to give you a sheet on which you can work out the various amounts which you need to put on the return. So things like dividends and interest income are calculated here. And in particular, social benefits repayment is calculated here. So the things to stress here is that if your income is over a certain threshold, you may have to repay either your EI income or your old age security income. For EI, it is set at 30% of the benefits that have to be repaid. Some benefits do not have to be repaid, so EI is a little complicated. And it is based on a threshold. In general, for EI, if your income for the year is more than $79,000, you may have to repay some of the EI. For old age security, if your income is higher than 90,997, then you may have to repay some of the old age security. So the calculation here on the form, the main thing to keep in mind is that the OAS is calculated. Any EI repayment is calculated first and deducted from net income from line 23400. So any EI that is repaid is deducted first, and then that amount is compared to the threshold of 90,997, and then any income over that amount, 15% of that is deducted from old age security. So if your income is high enough, old age security can be reduced to zero. I have seen some senior citizens who generally have a lot of investments who have incomes close to 200,000, things like that, who do not receive any old age security. And in those cases, the old age security, although it is issued by the government for accounting purposes, 100% of it is withheld at source and considered to be income tax. So it is a net. So the net effect on the tax return is zero. So main things to keep in mind is that EI and OAS can be repaid. The calculations are slightly different. In some cases, EI doesn't need to be repaid. For old AS, it's always just a question of how high their total income is. The logic behind each of these is that the government will send out this money on the assumption that somebody needs the money right up front, and then if their total income for the year is high enough, they obviously, can afford to pay it back. And although it's unlikely that someone will have both EI income and old age security income, it's by no means impossible. So in those cases, the EI repayment, if any, is applied first, and then the old age security repayment calculation is made. Okay, I think we're good there. Get back here. There. So speaking of things like dividends and investment income that are calculated on the federal worksheet, it's important. In this course, we talked about the three different varieties of investment income, broadly speaking. There is capital gains income, dividend income, and then all other kinds of investment income. Capital gains are their own special type of income with their own special rules. So they are we kind of think of them off to the side. In expenses related to capital gains are treated in a different way. Capital gains are taxed. There's a different inclusion rate. So they're kind of off the side. Generally, when we're talking about investment income as opposed to investments in general, we mean either Canadian dividends, which receive special tax treatment, or interest-bearing investments of other types, or foreign dividend or interest-bearing investments of other types, which do not receive special Canadian tax treatment. For dividends and interest, these are subject to attribution rules. Capital gains in general are not. For dividends, the attribution rules mean that whoever owns an investment has to declare the income from that investment. So this means if I am rich and I buy $100,000 worth of stock and then give it to my wife as a gift as a means of avoiding taxes, I am not allowed to do that, and the income will be attributed back to me. If she sells the stock, that capital gain, however, is going to be hers. So attribution, a very important concept. The main thing to remember is that it is based on the percentage that someone owns of an asset. So how much money did someone put into the asset compared to another person? Carrying charges, so these are investment management fees or interest borrowed for money to purchase an investment. These are deductible, but only for interest-bearing investments or dividend-bearing investments. So fees and investment and loan interest related to purchasing an asset are not considered to be investment expenses in this sense. They are instead capital gains expenses and handled a different way. Similarly, investment expenses are only deductible if they are for non-registered assets, so not investments in RRSPs or TFSAs or anything like that. So again, investment expenses, whether they're carrying charges or interest expenses, need to relate to unregistered non-capital investments. So you cannot claim as an investment expense something you're using to buy your house, say. Just remember the general principle that to be deductible, something has to relate to income. So if you're just purchasing an asset for your own use, which isn't going to, not for business use, not going to create income, then you're not going to be able to claim those expenses. Speaking of RRSPs, retirement savings plans, we'll talk about more of those on the next slide, but if you over-contribute to an RRSP, that is, you overshoot your contribution limit by more than $2,000, then it's necessary to fill out a form called a T1 OVP to calculate the penalty, essentially the fine. I was going to say penalty tax, but just a penalty on the overinvestment. This form is a real headache to fill out, so we really try to steer clients away from this if at all possible. The T1 OVP is different from the T2205. The T2205 is when a client withdraws from, as an annuitant, they withdraw from an RRSP that their spouse contributed to. So if I put a bunch of money into an RRSP for my spouse, and then she turns around and spends that money, again, this could be considered an attempt for me to get out of taxes. So if the spouse has contributed into the RRSP within the last 2 years, then the money that comes out, that income, is attributed back to the spouse that put in the money. If it's more than 2 years, however, not a problem. Moving expenses. Okay, guys. So what things need to be true in order for someone to claim moving expenses? There are some restrictions on when we can claim moving expenses. What are a couple of the big ones? Let's get back here. Right, 40 kilometers. Right, you need the 40 kilometers. It needs to be 40 kilometers closer to work, or if not a new job, then it has to be school, good, or it can be to carry on a business. Right, so work here could be a reassignment. If H&R Block was the sort of gold-plated company which said, Brian, please come to Calgary and write all our textbooks there, then that would qualify, even though I was working for the same company. That's not going to happen, by the way. Yeah, so we can think of it as there's kind of 4 things which need to apply, be true in order to claim moving expenses. So first, the purpose requirement needs to be for either a new job or for school or to carry on a business. Again, it needs to relate to income, right? Remember, it needs to relate to income. It needs to be more than 40 kilometers closer. So it needs to clearly be necessary in order to do the new job, the new business, and so on. It also needs to be, these are the subtle ones, it needs to be within a reasonable length of time. You're allowed to take some time to sell a house or things like that, but you can't say wait 10 years and then move and claim it that you had to move because of the job you got 10 years ago. And it also needs to be a genuine change of address. So it cannot be, again, it cannot be where you are in temporary housing, going up to work in a fishing lodge for the summer while your apartment remains rented in your original town or things like that. And it cannot be employer supplied housing or anything like that. It needs to be a genuine change of address. So Those are the 4 conditions which need to apply. As well, certain expenses are eligible and ineligible. There's an extensive list in the textbook. The main thing to remember is that if there's any kind of gray area, you'll want to see if this is an expense which is reasonably related to the move. Some things are a bit surprising. So, for example, if you have to move to a new province and get a new driver's license, the fee for the new driver's license is considered a moving expense. But if you pay for mail forwarding with the post office, that is not considered a moving expense. Bear in mind, you can also use the detailed or simplified method for calculating your moving expenses. The detailed requires all your receipts, and for vehicle expenses requires you to calculate your expenses for the entire year of the vehicle. The simplified method does not, but this only applies when you are driving a personal vehicle and for claiming meals. Anything else like accommodation or U-Haul or storage or things like that, you still need to claim based on the receipts. Any moving expenses which are reimbursed by the employer and not considered a taxable benefit, that is, they're not included on a T4 as income, those cannot be claimed. However, if your moving expenses are higher than what your employer pays for, so if your employer pays for $5,000 in moving expenses, but you have to sell your house as a result of the move, and that's not covered under the $5,000, then you could claim those house sale expenses, for example. For moving expenses, so in those cases, the key question is the employer reimbursement on the T4 as a taxable benefit? And lastly, the moving expenses, of course, can only be claimed against income from the new job or new position in the new moving location. So if necessary, if you move, say, near the end of the year and you don't start making income until the next calendar year, then you declare the moving expenses in 1 year, but they are carried forward to the next year and claimed against the income that year. They cannot be claimed backwards. Yes, Karina, the T1 OVP, so remember, that one is the T1 OVP, that is the overpayment into an RRSP. So that's if someone puts money into an RRSP above more than $2,000 above their contribution limit. So the T1 OVP is a special form which is used to calculate the penalty tax based on that over contribution. The over contribution calculation gets complicated because it is based on per month. So you have to track what contributions were made in a given month, how much someone was over their limit in a given month. And because RRSP's contributions never expire, there are cases where you sometimes have to go back more than 1 year, and sometimes much farther back than 1 year in order to calculate it correctly. So, it is, even if the amounts involved are small because the overpayment is relatively small, this form is always a headache to do. Any other questions about the T1 OVP, Karina, or are you okay with it? Okay, good. Yeah, anyone who hasn't looked at the form, I suggest just go have a look at it, just to get some idea what I mean when I say it's a real headache, because it is not fun to do, and it is complex enough that many software packages have trouble handling it. All right, last things on this page are kind of donations and political contributions, which are similar conceptually, but have some quite different parameters. For each of them, an important concept is the concept of advantage. So when you make a donation or a political contribution, you can only claim the net amount. So for example, if you buy tickets to a dinner and the food at the dinner costs $50, your donation or contribution is only the amount over and above $50. It is phrased slightly differently for donations and political contributions, but that is the important concept. There are many taxpayers just do not understand there is a distinction between political contributions and donations, and they will submit them to me bundled together on the same list or added together, and then I have to separate them. Charitable donations, they are treated differently. They are different credits and have different rules. So charitable donations, the first $200, you get credit at 15% federally and a matching provincial credit at the bottom provincial rate, but only for the first $200. Any amount over and above that $200, you receive credit at the taxpayer's top marginal rate, either 29% or 33%, depending on how much income they have. And also, the amount you can donate to charity is much higher than political contributions. Donations also do not immediately expire. You have up to 5 years to claim them. And what this means is that if someone, for example, donates $200 a year for 5 years, if they claim them $200 every year, they will only get a 15% credit, $30 per year. But if you claim 5 years of them at once, then only your first 200 would get the 15% credit, and the remaining 800 would get a 29% credit, which is close to double the amount. Political contributions are quite different. While they are still a non-refundable tax credit, they cannot be carried forward at all, but their credit amount is higher. 75% of the first $400 contributed, 50% of the next $350 contributed, and 1/3 of the remainder, up to a certain threshold, a bit over $1,000. Federal, I believe most provinces also have a provincial political contributions credit, but the contributions can only be claimed federally or provincially, because the contributions will either be to a federal political party or a provincial political party. There is never going to be any overlap between that. Depending on the province, of course, the provincial political credit, it will follow the same pattern as federal, but the thresholds will be different based on that province's rates. And of course, there's no such thing as a municipal political contributions tax credit, because there is no such thing as municipal income tax in Canada. In some countries there is. In the United States, for example, some cities have an income tax, some counties and even some school districts have an income tax, but in Canada the only two levels for income tax are federal and provincial. Hopefully it stays that way. All right, speaking of non-refundable versus refundable credits, by now you should all be able to explain the difference. So if a taxpayer comes to you, wants you to do their taxes, and they have a relatively low income, and they say, hey, I heard that I get a basic personal credit of $15,000. Does that mean I get $15,000? You may have to explain to them how it works. So can you explain the difference between a non-refundable and refundable credit? Tell me what you've learned. How would you explain it? Non-refundable credits can only reduce the tax owing to zero, right? A refundable credit can create a negative number. So it will lower the tax, and if it is a negative number, you will receive that amount back. Right? So a good way I find to explain to taxpayers with their non-refundable credits, I can say, this means, for example, your basic personal amount of $15,705. This means that your first $15,705 of income, you don't have to pay tax on, and it will cancel out the tax on your first $15,705. When I use that language, it's pretty clear to taxpayers what's going on. Often taxpayers people coming in to get their taxes done, they don't understand the mechanisms. They don't understand what the tax refund is, other than in some vague sense they submit their taxes and they get money back. So it's helpful to be able to clarify it for them. And so things like a charitable donation or a medical expense will not give you money back if you didn't pay any income tax to begin with, and so on. Sometimes I have people doing their taxes the first time. Students, for example, who come in with, they've heard some things and they have some very strange ideas about it, is all I can say. I've had them like thrust a tuition form at me and say, all right, I want my money back. It's like, but you didn't pay any taxes, so what money are you talking about? So being comfortable with the concepts of a non-refundable credit and a refundable credit, and being able to explain that to people is a very useful skill for people in our line of work doing taxes. Credits are different from deductions. Credits reduce tax. What do deductions reduce, everybody? Good. They reduce your income, and that is important because it can push you down into a lower tax bracket. The tax bracket is a range of income in which you pay tax at a certain range, and if you have income over that range of income, it will pay tax at a higher rate, and this concept is known as tax brackets. The general public tends to use the phrases credit and deduction interchangeably, but it is important for us to be able to explain the difference. In general, a deduction is going to be more beneficial than a non-refundable credit, although, of course, there will always be individual variations of that. Now, speaking of, for example, an example of a non-deductible credit would be the home buyer's amount, where if you purchase a home, you and or other people purchasing the home can get a certain amount as a tax credit for a first-time qualifying home. Whereas a home buyer's plan would be when you withdraw money from an RRSP and essentially make an interest-free loan from your own retirement fund to yourself in order to buy a home. The benefit there is that if you are putting money into the RRSP to withdraw it under the home buyer's plan, then you get to claim a deduction, which reduces your income and gives you a tax refund, presumably. The key thing to remember is that anything put into the home buyer's plan and then withdrawn for an RSP needs to sit in the plan a minimum number of time, a minimum number of days, a minimum amount of time before it can be withdrawn and you receive an RSP receipt. And that period is 90 days. So I'm always careful to stress this to people. Another example of employment-related non-refundable tax credit is the Emergency Services Volunteers Credit, which can be claimed by volunteer firefighters or search and rescue volunteers. There needs to be a minimum number of hours worked, 200 hours, and if they have a certificate for the 200 hours, then they can claim the credit. If they do claim the credit, however, they must include any income from Box 87, which would normally be exempt from income, being included in taxable income. That income has to be included as employment income if you are claiming the credit. Bear in mind, some firefighters do not have the 200 hours, so they cannot claim the credit, and so they would want to claim the exemption. And some firefighters have the credit but do not have the exemption. The volunteer firefighters I see, they have a letter for the volunteer hours, but they are not receiving any exempt income, so it's fairly straightforward. But in a case where someone might qualify for both, in almost any case I can think of, it would be more beneficial to claim the credit. All right, tax brackets, Karina, remember this is a range of income in which a certain percentage of tax is paid. These are the diagrams that we see on the T1, for example, or on the provincial forms. So for example, for Nova Scotia, if we were to look at theirs, so provincially, these are on the 428, and they are pictured like this in a diagram like this. So for example, in Nova Scotia, the first 29,590 is taxed at 8.79%, and then the next 30,000 or so is taxed at 14.95%. The next 34,000 or so is taxed at 16.67%, and so on. So these are called tax brackets, and we can think of them as a range of income within which a certain the income is taxed at a certain percentage. When we talk about moving to a higher tax bracket, then we're talking about income that is going to fall in a higher range where it is going to be taxed at a higher rate. Right. Any other questions about tax brackets, Karina? Right. Good. So again, tax brackets are one of those things that the general public talks about a lot. People use the term a lot, but not everyone necessarily understands. So it is helpful for us to be able to explain the concept and, if necessary, draw a picture just so that people have a clearer understanding of how their tax is calculated. A common misconception, for example, which is often perpetuated by certain, let's say, politicians, is the idea that if you are in a higher tax bracket, all of your income is taxed at this higher rate, which is simply not true, and a misunderstanding of how a progressive tax system works. All right. Now, an important concept when we're talking about tax brackets is that someone's income, what is taxed is based on the figure which is their taxable income. However, taxable income is often lower than someone's total income. Deductions are applied to total income to give you a lower net income. Deductions can be applied to net income to give you a lower taxable income. For some people, they will have no deductions, and those three numbers will be the same. For other people, they will all be different. But the largest number will always be total income, the medium number will be net income, and the taxable income will be the smallest number, and that is what actually has tax paid on it. Net income is used to calculate someone's eligibility for refundable credits, such as the GST credit and things like that, which we've talked about. But it is also used in calculations for certain other things. For example, medical expenses. Medical expenses, the government considers, the way I explain it to people, the government considers medical expenses of less than 3% of your net income to be kind of normal. So you can only claim medical expenses if the total is higher than 3% of your net income. That said, you are allowed to combine medical expenses for the entire family. So that is the parents and any children 18 or under. All of those medical expenses are combined and can be combined, and they can be claimed by one person, usually the person with the lower net income. In a case where that person, their income is too low to claim anything or get any tax refund, then there's nothing to stop you putting it on the return of the person with the higher net income. But in general, it will be more beneficial for the person with the lower net income to claim them because they will be able to claim more in medical expenses. For dependents over 18, you can also claim their medical expenses as well, provided you paid for them. However, they are reduced by 3% of the dependent's net income. Other things to keep in mind with medical expenses is that you can claim them for a 365-day window. So while you cannot carry them forward in the traditional sense, you can claim medical expenses from the previous calendar year to a limited extent in order to give you a higher total for that total of medical expenses. Some specific things with technical considerations can arise with medical expenses. So for medical expenses to be claimable, they need to be recognized as a medical expense by the CRA, or they need to be a service which is provided by a recognized medical practitioner, and the specific medical practitioner practitioners which are recognized for this purpose will vary by province. Another technical consideration is that if you are claiming the disability tax credit, you cannot claim that in combination with attendant care of more than $10,000 claimed as a medical expense, and nursing home fees claimed as a medical expense in any amount. So you recall somewhere reading that if someone is over 18 and going to school full time, so you're talking about a dependent of yours who is over 18 and going to school full time. You can claim their medical expenses. Yes, yes. Well, that is true if you're not going to school. I think this is most commonly encountered when someone is going to school, right? Someone is going to school, they're away from home, they don't have any significant income, so you have to pay their medical expenses. But there is no actual restriction that they need to be going to school. I have seen it, for example, where someone's son was a professional athlete and they were paying the medical expenses, so that's fine. It is, however, necessary that you actually be paying them. It's a general rule in tax, and particularly with medical expenses, that the person who pays them can claim them. So this is within the family. I can pay for my wife's expenses, that's fine. But if I'm paying for, but if say my grandfather pays for my medical expenses, then I cannot claim those expenses, only he can. All right. Child care expenses. Again, net income comes into it in an interesting way here, because for child care expenses, remember the purpose of this deduction is for them to allow people to go to work. So these can only be claimed by people with earned income, so they are going to work. Single taxpayers require earned income, or if they're going to school, then they can use their net income, and they can claim the child care expenses against that. For a couple, the lower income member of the couple usually has to claim the child care expenses, because remember, the purpose of the child care expenses is to allow the secondary taxpayer in a couple to go to work. If the primary taxpayer in a couple is working, the child care expenses, presumably the secondary taxpayer cannot work because they are providing child care. So they can deduct the child care expenses because it allows them to work. We can see how this would obviously be, otherwise you would get situations where wealthy taxpayers with a very high, well-paying job are claiming child care expenses while their spouse is sitting at home and not doing anything. Bearing in mind, of course, that if the secondary taxpayer is unable to provide child care due to a disability, infirmity, being in prison, going to school, etc., then there are provisions for the higher income taxpayer to claim the child care in that case. The child care which can be claimed is limited by the age and number of the children, the amount of the child care expenses themselves, and or the amount of earned income. Because again, and this all makes sense if we remember, the primary purpose of this deduction is to allow single taxpayers or secondary earners to enter the workforce. The attendant care limit. So there is no limit for attendant care as a medical expense if you're not claiming the disability tax credit. If you are claiming the disability tax credit, then the limit is $10,000. Right? So as always, in a case like that, you would want to look at it and say, okay, what makes more sense to claim? What will be more beneficial to claim? So if someone has attendant care medical fees which are far higher than the disability tax credit, then you might claim those, right? But yeah, the limit simply applies to whether or not you can also claim the disability tax credit. And again, with the disability tax credit, remember a separate application needs to be made to the CRA to allow someone to qualify for the disability tax credit. And again, disability is a more prolonged and severe version of an impairment or infirmity, which merely requires a doctor's certification. Okay, speaking of couples and single taxpayers, we also talked about the implications of changing someone's marital status in the year. This needs to be promptly reported to the CRA because this will affect someone's eligibility for refundable credits that they are receiving throughout the year. When someone's marital status changes in the year, the rules are slightly different if they are moving from a single situation to a couple situation or vice versa. But that all revolves around dependence. So if one spouse has a lower income, if there are children involved, then most of the implications around changes in marital status affect that. We also looked at the technical definitions of marriage versus common law. Marriage, of course, married taxpayers, there's a legal agreement, there is a marriage ceremony. Common law taxpayers simply live together in a conjugal relationship for a certain period of time. If a child is involved, that is a child of both taxpayers in one way or another, then the 12-month waiting period doesn't apply, and they are considered immediately common law, and this allows them to access more benefits, typically. After a separation, or in the case where someone is not in a relationship with someone, but that person does have the taxpayer's child, then support payments can come into play. Remember, support payments for tax purposes need to be legally required. They need to be of a set amount, and they need to be periodic, something like pension income in that regard. So they need to be periodic, set amount, according to a legal agreement. Child support payments currently are declared on the return, but they are not included in income for the recipient. They are not deducted from income for the payer. This is as opposed to spousal support payments. Spousal support is deducted from income for the payor and included in income for the recipient. There are a few other technicalities around support payments, but that's the main thing to remember. Child support has no net effect on the tax return, but has to be declared. And if someone does not pay the full amount of combined child and spousal support in the year, everything they do pay is considered to be child support until they have paid the child support for the entire year. Only whatever is left over is considered to be spousal support. Legal fees can be claimed in some cases on the tax return. Typically, legal fees to be claimable on the tax return need to relate to income in some way. So these can be legal fees when taking an employer to court for certain reasons to get back pay or things like that. For things like child support, legal fees for the person collecting the child support are often deductible. So legal fees for increasing, collecting, or establishing support would be deductible, but they are not deductible if, say, just drawing up a custody agreement or finalizing a divorce, and they are never deductible by the person making the support payments. The specific type of legal fee will determine what line of the tax return it is on. Some legal fees are claimed more like investment expenses, and some are more like miscellaneous deductions. So it depends on the specific type of legal fee as to where they go. All right. There's a cluster of topics around senior citizens, particularly the age amount is a good one to be aware of. This is something someone receives when they turn 65, bearing in mind that they, I don't want that one. I don't want that one at all. I want this one. So bearing in mind for the age amount that for this one, we are looking at T1. The age amount is only for seniors, but what I want to stress is that the word senior is never used. It is simply based on someone's birth year. So the age amount, you get that if you were born in 1959 or earlier for a 2025 return. So you receive it once you are 65, but we never use we never say age 65. We never say senior citizen. Senior citizen, because that is a subjective statement, and instead this is an objective fact. And we don't say 65 because we never want to mention anyone's age. So it is simply referred to as the age amount, and this is reserved for seniors. It is calculated using the federal worksheet. So seniors, it is intended for seniors of modest income. So if someone's net income is less than $44,325, they receive the full amount of $8,790. If their income is more than $102,925, they don't receive any of this amount. Otherwise, their income over the base threshold of $44,325, 15% of that is deducted from the age amount to determine the credit. So the age amount then is something you receive as a senior. And another thing received only by a senior is the pension income credit. Now, there's an entire chart that we looked at for pension income over the question of whether something is pension income or not. The general rules, similar to support payments in this regard, it needs to be of a fixed amount received periodically. So a steady stream of income rather than a lump sum. So it cannot be a lump sum, and it cannot be Canada Pension Plan or an OAS payment. It needs to be essentially private pension plans of one sort or another, and foreign pension plans of one sort or another. If some source of income qualifies for the pension income credit, it will almost always qualify for pension income splitting. This is beneficial because it allows a higher income senior to transfer some of their pension income to their lower income partner. The pension income credit, like the Canada Employment Credit, is a credit that allows you to get your first $2,000 of pension. It gives you a credit equivalent to $2,000 of your pension. So this means then that the tax is canceled out on your first $2,000 of non-CPP, non-OAS pension. Just like with the Canada Employment amount, your first $1,400 or so of employment income, the tax is canceled out on that. So pension income splitting, for one thing, allows the higher income taxpayer to move down into a lower bracket potentially, and allows some of their income to be put onto their lower income partner who will be in a lower bracket. At a minimum, it's typically going to be advantageous to at least transfer $2,000 to a partner who does not have pension income so that they can use the pension income credit to cancel out the tax on $2,000 of the pension income. Foreign income plays into this here because for many taxpayers, they have a foreign pension of some sort. Commonly, U.S. Social Security is a very common pension type. Foreign income is reported on the Canadian return in Canadian dollars, and it is reported on the same lines as the corresponding Canadian income. So foreign investments are combined with Canadian investments on line 12100, for example. The main thing to remember, and foreign pension income are on line 1, is included in line 11500 with Canadian pensions. The main thing to remember with foreign pension income is that any exempt amount is deducted from the deduction is entered separately on the return from the pension income itself. So the pension income, which we would see, there we go. So the pension income would, if say someone is getting U.S. Social Security, then the pension income would be on line 11500. There we are. So the pension income would be on line 11500, other pensions and superannuation. And the entire amount in Canadian dollars will be included here, including any exempt amount. The exempt amount is non-taxable, so the exempt amount will be included on line 25600. Okay, so we enter the gross amount at 11500, and then any exempt amount is entered down here. The specific exempt amount will depend on the specific tax treaty between Canada and the other country. The CPT 20, CPT 30, again, as the name implies, 20 is for younger taxpayers, 30 is for older taxpayers. That's how you can kind of remember. CPT 20 is when you want to pay CPP on pensional income that hasn't had any CPP withheld on it. The CPT 30 is used for a taxpayer who is between 65 and 70 who wants to stop contributing into CPP. If someone continues to contribute into CPP after hitting 65, then they will receive that money back as kind of a CPP supplement, and it will show up separately on the T48P. Penalties and interest. So remember, interest is applied when someone owes money to the CRA and they haven't paid it, so the interest will accumulate over time. And penalties are assessed when someone does not file on time, or administrative penalties for some other things. So repeated failures to report income, for example. Remember that if someone files something late and there is no balance owing, this does not result in a penalty because, 15% of zero is zero. But for administrative penalties such as late filing for a T1135 or a primary residence deduction, then principal residence exemption, then those penalties, even if the tax difference would be zero, those penalties can be substantial. So in particular, the T1135, there can be penalties even if someone owes no tax, because that is a reporting requirement. With interest, the CRA will also pay out interest. So the key thing to remember is that if you owe the CRA, then you have to pay interest beginning on the day that the tax should have been paid. So if you file your taxes 5 years late, you will have to pay 5 years worth of interest. If you're getting a refund instead and you file your taxes 5 years late, the CRA will not pay you 5 years of interest because it's your responsibility for not filing it on time. If, however, you file your taxes 5 years late and it takes the CRA 6 months to process those taxes, then you will receive 5 months worth of interest. The first month you don't get interest on because they allow themselves a month to get everything filed and sent out. All right, so on that note, any questions? Is there anything you'd like to have a look at? No questions? Yes, I'm such a good teacher. Yes, fantastic. All right, good. Right, of course, if you do have a question, you're just typing out, that's perfectly fine. But this means, congratulations, you've done it. You've gotten through the course. You've completed it. It was a heavy lift. I want to commend you all on seeing it through to the end. Many people do not manage to make it through, so well done, all of you. All right, now Valerie has a question. Let's have a look at that before we get back to this, so that we don't forget it. Mainly, Valerie. So you want to look at the optimization. Does the program always show what is the best way to do medical expenses? Who should claim them? I think that's a good question, and I'm going to pull this out just because I think this is a worthwhile topic, I think, just to spend a moment with. Okay, yeah, no, I don't need that, don't need that, don't need that. I do need this, and I need to not be in the writer view, because bad things can happen. Yes, yes, it's me. Yes, it's still me. There we go. There we go. And we want to filter by BC, and we want case study 1-3. Right. And you're wondering about donations and medical expenses. All right. So for anyone who missed it when we went through in class, so in this software, in BlockPro, this concept is called optimization. Most tax software packages use a similar concept. The idea of optimization is putting the tax credits or deductions where they will do the most good. Depending on how the specific tax software works, there may be different types of optimization or allocations or things like that, which are possible. You can kind of think of it as fine-tuning the return. Here in BlockPro, it is done under the Review tab after you've entered. Annotation, please. Thank you. Right, so under the Review tab, after you've entered all of the taxpayer's tax information. So in 1-3, the main thing that came up was, of course, the pension income splitting. But underneath, you can also claim things credits. So in this particular software, well, this is a toggle you can select. So you can, in this particular software, you can either use the optimized amount and carry forward the remainder, or you can apply each to the spouse who made it. You do not have the option to force it to put the amount on just one spouse, to combine it all and put it on a spouse who isn't optimal. In this case, it's the optimized amount. When we look at their tax summaries, however, you can see why, in this case, if I recall correctly, because Janet's income, which is going to be on the right here, is only $29,093.63. With the other things she's claiming, namely the medical expenses, and you want her to claim the medical expenses because she has a much lower net income, so she can claim more of them. After her medical expenses are claimed, she only owes $28.54 in federal tax. So those donations would be wasted if they were put on her. So in this case, it's a really clear case where you would want to put the donations, right? $689.75 in credits, and she can only absorb $28.54. So in this case, it's obvious the optimal view is to put it on the husband. However, when you're out there in the field, it may not always be so obvious. So the donations come into play here. For the medical expenses as well, if we go back to optimization, again, they are best claimed by Janet because her net income is much lower. But you do have the option to split those as well. That comes down here. So unlike donations and gifts, where you need to kind of choose who's going to claim them, here you can split it if you want between the two of them. I'm not sure why it doesn't give you the option to split them. I think it may be because donations, you cannot actually divide an individual donation between a couple. So if you have a $500 donation, it has to go to one or the other. Whereas with medical expenses, you may be able to kind of divide the total into one or the other. But again, because it's going to be compared to someone's net income, you're typically going to want to have all of it be claimed by the partner with the lower net income. Although, again, I could see situations where someone's tax owing is very low, so they only need a little bit of a medical credit. But that's the sort of fine tuning that you can kind of get into after you've been doing tax for a while and you look at the fine detail of it. But in this one, it's really clear. She needs to claim the medical expenses because her net income is much lower, so she can claim much more of the medical expenses. And then after she does that, he has to claim the charitable donations because otherwise the credits are going to be wasted. So they should be claimed by him or pass forward to a future year. Various different software packages can behave a little bit differently when it comes to things like this. So um, I never really think that it's hinting, say. I don't trust it and things like that. I want to be able to understand what its logic is. And if it's not doing something the way I think it should be done, then often there's something that I haven't done correctly or something within the individual software that I need to tweak. And again, I've dealt with more than one piece of tax software. Um, yes. So sorry, Valerie, is that for the medical expenses or for the donations? I just want to make sure I understand. For the medical. So if you wanted to change it, again, for anyone who missed it, or if we didn't cover this adequately last time, if you wanted to change it, click the lock to unlock it, and then you can put it over here, right? That's how you can change it in this software, in case that's not clear, right? But this is good behavior to be aware of. If you put it in under him, then it's going to default to this, uh, potentially, but you should always have an eye on what makes most sense. And if the software is not doing what makes the most sense, then you need to step back and look at it and say, okay, why isn't it doing that? Generally, it should. Most software should. In some software, you can opt to toggle on or off optimization. This is really where your tax theory becomes important. A lot of software packages will just do what you tell them to, but they're kind of dumb and they may not know about subtleties. Or if they do know about subtleties, it'll be in kind of a crude way. They'll say, this taxpayer has the lower net income, so they should always claim it. When in fact, there might be circumstances where that's not the most beneficial thing to do. So, but yeah, in general, this software, it'll give you the option to optimize things. It'll show you what's doing, but you can also play around and move things around and then run the calculations and then see if it gives you a better overall result. Okay. All right. So, and again, if you have any more questions, don't worry. I'm not going to run away tonight. I'll be around. But first, let's talk about some of the administrative stuff. So, after tonight, our session is only finished as of tonight. So I can, even if I had all my numbers ready to go, I would still have to enter them after tonight because I need to include the attendance for tonight. So I update the attendance, and once in this in the ULearn platform, once I close and enter things, then the course itself closes and I cannot edit it anymore. So I'm very paranoid about not closing the course until I'm absolutely certain that everything's done and everyone's concerns have been addressed. So once I've done that and the course is closed, then you will show as completed and you will be able to download your certificate of completion. And this applies if someone has a passing grade of 70% or higher. One of the things I go through when I'm downloading everybody's grades is just keeping an eye out and then seeing if anyone's missing assignments and things like that. And one of the things I do is send out a preliminary email to everyone saying, this is your grade in the course. And some students have gotten that and gotten back to me and said, wait a minute, I actually did assignment 2. So although we always send out an email, I personally like to send out the email and give students a chance to just reply if they're objecting to something before I actually close things. So give me a couple days uh, before expecting things to be closed. But once I close things, it'll be obvious in ULearn, and at that point, you'll be able to download your certificate in ULearn. So go to your transcript. It's a drop down from the Active tab, select Completed, and then View Certificate. In January or February, but probably January, you will be mailed out your T2202 by mail. Make sure your social insurance number and address are up to date in ULearn today in order to do that, because we have to mail them out and we have to have your SIN number on them. If you have trouble finding where to do that, do contact tech support, because they can steer you in the right direction. Your interface is going to be slightly different than mine. For me, that information is updated through my payroll department, and I cannot manually update my information, so I might do it a different way than you do, say. But yes, if you go into your profile in ULearn, you should be able, and ULearn Bio, you should be able to access that. We will also be emailing you an evaluation survey, so we want to hear from you. This is anonymous and it is aimed at approving all our training. So if you are sending us feedback through this form, bear in mind that we love to get constructive feedback, but think about what would be helpful for us. What's helpful for us is things like, we would like more time spent on this topic, or this topic didn't seem clear. What's less helpful for us is things like, oh, I didn't like the students in my class, or if only some small things were not 3 hours long, or things like that. There's things we can change and things we can't change, and then there's things that are out of our control. But things like were there assignments that you liked or didn't like? Would you have liked more focus on different topics? Do you think we covered too much material in this course? Not enough. Things like that. That is all very useful to us. There are certain things like the number of sessions in the course, or the general overview of the course, that are very difficult to change, but things like, oh, could we have more chapter review problems or less chapter review problems? Things like more time spent on chapter review problems in class or less time spent on chapter review problems. That's the sort of thing we can work with. This will be sent to you in your email. The textbooks you'll also be able to download. So the downloadable PDFs will be available for all of the major learning materials. So fundamentals of income tax, facts and figures, the Tax Academy reference, and the provincial supplements. You can download PDFs of individual sections in the textbooks now, but the textbooks as a whole you'll be able to download. We expect them to be available in late January 2026. Your Inkling access will terminate sometime in February 2026. They don't tell me exactly when, so you may have a relatively narrow window of time to download them, so don't delay when you get that notification. If you are coming to work for us, of course, we have access to Inkling as employees all the time. That's one of the reasons why my Inkling library has 500 books in it. But for anyone who isn't, be sure to download those at the appropriate time. You'll notice that there's no Block Pro textbook, and that's because if you're coming to work for us with us, you will have access to that. And if you're not coming to work with us, that won't be the tax software package that you're going to be using. So there's no sense in giving you that textbook. Is there an answer key if you want to try more of the software exercises or case studies? We've kind of tried all the ones in the textbook. Are you wanting to try? So there's the 4 exercises and then the 5 case studies. So you're just wondering about answers, sort of an answer key there. If in that case, just shoot me an email and say, hey, I got this result for this case study, or this result for that exercise. Is this correct? Just let me know, and I can tell you whether you're on the right track or not. Bear in mind the exercise and case studies are all in our recorded sessions too. So while we may have covered them pretty quickly in class, you can go back and have a look at them and say, aha, the answer should be this, or the answer should be that. A few more beyond 1-5. I don't know if there's more in the textbook. What you can do, you can take the chapter review problems from the main textbook and try them out in the tax software, though, I would say. But yes, for the actual Block Pro, for Block Pro, yeah, we only have those exercises available. But yeah, there is nothing stopping you doing the chapter review problems from the main fundamentals textbook if you want. And I think that might be a fun exercise too. Yeah, just for practice. What if an online session was missed but then watched offline? Well, the answers would have been recorded. Christina, I'm not sure I understand the question. Yeah, here we are. Oh, does it count as attendance? If you sent me an email, don't worry too much about attendance. If you've sent me an email about it, typically I will find that and say, okay, this student sent a message, and then I will update it accordingly. So if you sent me an email at the time saying that I can't attend to class right now because I'm trapped on a mountain in a snowstorm with a handsome novelist, then that's perfectly fine. If you've sent me some sort of reason for missing it, then that's perfectly fine. Okay. Yes, Humaira, I did see that. I need to follow that up with my superior, so not to worry. I need to kind of focus on getting everyone's marks in, but I will follow that up. Okay. Okay. So you missed it. In terms of attendance, I wouldn't worry too much about missing a class or two. It's the software ones that the only. Okay, so for me, when I submit the marks, I submit the attendance, but the attendance has nothing to do with whether or not you've passed the course. For employment purposes, the company likes to be able to check your attendance and see that you actually attended the sessions with the software sessions. So if you missed one of these last 3 sessions, but you did them at home and did the exercises, so your software, so you submitted those case studies, then I think A, submitting the case studies is more important, and B, just send me an email to let me know you weren't here, but you did do it at home and reviewed the video at home, and then I can adjust that accordingly. I don't mind doing that. Oh, yeah, so to answer a question sent privately, if you haven't done your case studies yet, do them now. I think they are still open. I don't think they're about to close or anything like that, but don't leave them too long. And yes, of course, if you were ill or had COVID, just send me an email letting me know that, and I can adjust things accordingly. What is going to take the bulk of my time this week for the next few days is just pulling in everyone's marks. I think I mentioned, in case I didn't, my understanding is that there are 1 or 2 questions where ULearn wasn't marking them properly, so I do need to go over and just make sure that everything's okay. So that's going to take me a few days anyway. So if you haven't sent me an email about attendance, you've got time to do that, and you've got time to do the case studies. Okay. In the meantime, don't panic if you can't download the certificate or anything like that, because that can't happen until I close the course, and I don't want to close the course until I know that all of your outstanding issues have been resolved, because once it's from my point of view, and you learn, once I close the course, it vanishes and I can no longer interact with it in any way. All right, but I think that covers everything. And if this were a traditional in-person class, we could just go to the cake and cookies part of things. But I think for us, might be more fun just to hang out a little bit. So if you have any questions, you can bring them in. And where did I put it? Oh, I put it here. Of course I did. Yes, there we are. All right, so there we are. Let's get this shrink down. So it's time for our class to make a Christmas card. Okay, so I have enabled your annotation. Everyone is allowed to annotate. You should all be able to annotate now. There you go. All right, and so here's a nice little Christmas tree. Let's make ourselves a nice little Christmas card. There we go. So if you've got any questions, you can drop them in the chat. Let's just spend a few minutes putting it on here. I would try to put on some music, but I'd be worried about losing our picture here, which I'm going to screen cap in a moment. Oh, yeah, let's put a nice little something up here. There we go. Oh, very nice, very nice. Maybe a nice little holiday rug down around the floor. There we are. Oh, there we go. Splendid. Maybe put an ornament on the tree. Oh, yeah, there we are. Maybe put some garlands on in the background. There we go. There we go. Splendid. And maybe put a little, oh, I know, put a little fireplace over here. All right, and I think maybe we'll put some get our traditional Christmas fireplace going there. All right, and maybe put a little Christmas log in there. Oh yeah, there we go. We want maybe a little Christmas stocking up here, just like this, hung by the chimney with care. There we are. Oh, can't move that one. There we go. Oh, splendid. Oh, look at those. Oh, that's just delightful. All right. Very good, very good. Oh, I think we're almost there. Oh, yeah, look at those. Look at those darling little shapes showing up. Oh, and some ribbon. I like it. Ah, wonderful. Very good, very good. All right, students. Well, I'm just going to try to screen capture this right now because I think we've pretty much got it where we want. All right. So very carefully, try to do it. Oh, not quite done yet. That's perfectly fine. As I say, in the old days, we would be hanging out after class and enjoying some cake and cookies and punch and hot chocolate. So after we wrap up tonight, I urge you all to go have something festive for the season and relax for a couple days while I do all my administrative stuff. Uh, you're very welcome, Valerie. My email address, by the way, is permanent so long as I'm with the company. So feel free to reach out in the future if you need anything. Doreen as well. We are tax professionals, so we are used to getting questions from people at all times of the year about all kinds of things. So don't be shy in the future about reaching out. One thing to be aware of is that while we are very busy when we are working for the company for the first 4 months of the year, we are very busy with taxes and all, so we can't always respond right away. Then for the rest of the year, we're often not working full time, or sometimes not for months at a time. So if you send us an email and say August or September, don't read anything into it if you don't get a reply right away, because we may just not be in the office, or we may be only being paid one hour a week, and so we don't have time to do all the emails right then. But we do get your emails, and we will respond when we get a chance. All right. So happy holidays, everybody. I'm going to try to screen capture this now. Oh, yeah, there we go. There we go. Oh, no, let's try that again. Want to get it just so. Oh, yeah. All right. And as always, if you think of anything after the fact or anything like that, and have any questions, just send it my way. You rock too, Doreen. Well done, everybody. All right. Thank you, Grant. I appreciate all of you, all of your contributions, all of you. I want you to. It's really the contributions which make everything. Oh, did someone put another ornament in there? Okay, I'll get a fresh capture. I know how Christmas stories go. You always want to get every little thing. All right, there we are. All right. I want to capture it because if I do it wrong, I might lose the entire image. So I'm gonna stop sharing now. Oh yeah, see that's what happened there. Okay, but don't worry, I've got it. Just hang tight and I'll drop it into new email here. Oh, there we go. Splendid. All right, yeah. So I'll send that out to you guys tonight. All right, so happy holidays, everyone. Well done. Give yourselves a well-deserved pat on the back. Happy tax filing indeed. I hope you all have a good holiday season with your spouses and common law partners and dependents. And so I'll see you all down the road for tax season. Great job, everybody. When is the final exam? You've written the final exam, the theory exam, right? So there is no final software exam. There used to be, but there isn't anymore. You should have written the final exam by now. The theory exam is the final exam. The next step is all for me. I will be looking after things and sending them and wrapping up the course. For submitting the case files, I think the expectation is that you do them. It will not affect whether an offer is made or not. I do think that if you don't submit them, then the offer is any offer is conditional on you doing the case studies, it means that you've done the software and we don't have to train you from scratch on the software, basically, right? So yeah, if there is an offer or you're wanting to work with us, definitely do and submit the case studies. And if you're having any issue with submitting them, do contact tech support about submitting them. All right, well, thank you, everybody. Doreen, thank you. You're a rock star. You're the wind beneath my wings. So I will keep the room open for the next hour or so if anyone's got any questions. But students, I don't want to keep you hostage. You are free to go. Doreen, oh, actually, yeah, no, that should be fine. I don't know when the window for the case studies closes, but bear in mind that there are other sessions of this course which started a week after us, so those will still be open. And I suspect as long as those are still open, then you should be able to submit. The main thing is pretty much all courses need to be done by, say, mid-December because it affects, we need to let people know about job offers and such before Christmas. Okay, if you haven't said the case study yet, in other words, please do so in the next few days would be my advice. I don't think my closing the course would affect your ability to access Block Pro, but I would rather not take that chance. So do them as soon as you can, in other words.